Today we will be discussing one of the key indicators of the company's short-term financial health, liquidity ratios. First and foremost, we will look at the current ratio and quick ratio and compare the performance of two companies, which is Ideal Capital Berhad and ILB Guru Berhad. Let's start with the current ratio. The current ratio measures how well a company can pay its short-term debts using its current assets. These assets includes cash, inventory, and amounts owned by customers. Current liabilities are debts that must be paid within 1 year. A higher current ratio such as 2.0 means the company has twice as many current assets and current debts, suggesting it should have no trouble paying its bills. However, a low current ratio like 0.8 may indicate difficulty meeting short-term obligations. For example, let's take a look at the Ideal Capital Berhad. The current ratio is 2.30 to 1, meaning it has more than twice the assets needed to cover its short-term liabilities. For ILB Guru Berhad, the ratio is even higher at 4.64 to 1, showing very strong liquidity. Next, we look at the quick ratio, also known as the acid test ratio. This ratio is more strict because it only uses assets that used be turned into cash quickly, such as cash, bank balances, and receivables. Inventory is excluded between it typically takes time to sell. A quick ratio above 1.0 means the company can pay its short-term debts without relying on inventory. A ratio below 1.0 may signal liquidity pressure. For Ideal Capital, the quick ratio is 0.58 to 1, which means the company may struggle to pay its short-term debts without selling inventory. Meanwhile, ILB Guru Berhad has a quick ratio of 4.12 to 1, indicating the excellent liquidity even without inventory.
Assalamualaikum and hi. Today I will briefly explain two profitability ratio, which are profit margin on sales and return on common shareholders equity or ROE. So the first one, profit margin on sales, measure how much profit a company earn from its total sales after all expenses and taxes. Basically, it shows how efficiently the company turns sales into real profit. For Ideal Capital Berhad, the profit margin is 0.1 to 1. This means the company earned 10 cents of profit for every ringgit of sales, showing good efficiency. However, ILB Group Berhad has a negative profit margin of negative 0.6 to 1. This means the company lost 60 cents for every ringgit of sales, showing that it is struggling, possibly due to high costs or low revenue. Return on common shareholders equity or ROA. So ROE measures how effectively a company use shareholders' money to generate profit. For Ideal Capital Berhad, the ROE is 0.13 to 1 or 13%. This means the company earned 13 cents of profit for every ringgit invested by shareholders. This shows strong and effective use of shareholders' fund. On the other hand, ILB Group Berhad has negative ROE of negative 0.04 to 1. This means the company lost 4 cents for every ringgit invested. The negative ROE reflect poor performance and inefficient use of shareholders' fund. So, in conclusion, Ideal Capital Berhad shows better profitability in both ratio, while ILB Group Berhad is experiencing loss.
For leverage ratio, the first one, debt to asset ratio. One example of a leverage ratio is the debt to asset ratio. which measure the proportion of a company's total debt to its total asset. A company has more debt than asset if the ratio of debt to asset is greater than 1. The second one is debt to equity ratio. The debt to equity ratio indicates a company's financial flexibility in relation to its debt. You may get a company's leverage ratio by dividing its total debt by its total shareholders' equity. Next, we move to the calculation. For debt to asset ratio, for Ideal Capital Berhad, the ratio is 0.56 ratio 1. For the interpretation, Ideal Capital Berhad has a debt to asset ratio of 0.56 ratio 1, meaning 56% of the company's assets are financed by debt. This indicates a moderate level of financial leverage, showing the company relies partly on borrowed funds but still maintains a reasonable balance between debt and asset. For ILB Group Berhad, the ratio is 0.20 ratio 1. For the interpretation, ILB Group Berhad has a debt to asset ratio of 0.20 ratio 1, meaning 20% of the company's assets are financed by debt. This indicates a low level of financial leverage, showing the company relies more on equity than debt and is in a strong financial position with minimal risk. Second one, debt to equity ratio. For Ideal Capital Berhad, the ratio is 1.25 ratio 1. For the interpretation, Ideal Capital Berhad has a debt to equity ratio of 1.25 ratio 1, meaning the company uses RM1.25 of debt for every RM1 of shareholders' equity. This indicates a moderate reliance on debt financing, showing a balanced capital structure with manageable financial risk. For ILB Group Berhad, the ratio is 0.25 ratio 1. For the interpretation, ILB Group Berhad has a debt to equity ratio of 0.21 to 5 ratio 1, meaning the company uses RM 0.25 of debt for every RM1 of shareholders' equity. This indicates a low reliance on debt financing, showing the company is in strong equity position with minimal financial risk.
Okay, now for activity ratio. The first one is a total asset turnover. Total asset turnover means how eventually a company uses all its assets such as buildings, equipment and cash to generate sales. It shows how many ringgit of sales are made for every ringgit invested in assets. A high total asset turnover means the company is using its resources effectively to produce more income, while a low ratio suggests the assets are not being used effectively. The second one for the account receivable turnover. Account receivable turnover shows how well a company collects payment from customers who buy on credit. It measures how many times on average the company turns its receivable into cash during a period. The ratio shows how effective company credit policy collection policies are. A high turnover means customer pay quickly, improving cash flow. A low turnover shows the company may have trouble collecting payments or customers are paying slowly. For total asset turnover for Ideal Company Berhad, it shows as 0.05. For interpretation, the company total asset turnover ratio of 0.05 indicates that for every RM 1 ringgit invested in asset, meaning only RM 0.05 is generated in sales. This reflects low asset utilization efficiency and suggests room for improvement in managing assets. For ILB Group Berhad, total asset turnover is a 0.15. For the interpretation, the company total asset turnover ratio of 0.515 indicates that for every RM 1 ringgit invested in assets, that means only RM 0.15 ringgit is generated in sales. This reflects low assets utilization efficiency and suggests room for improvement in managing assets. The second one is account receivable turnover.
For Ideal Berhad Company, account receivable turnover is 1.92. For interpretation, an account receivable turnover ratio of 1.92 indicates that the company collects its receivable about twice a year. This shows a slow collection period, suggesting that the company may need to improve its credit and collection account receivable. Now, for ILB Group Berhad, account receivable turnover is 2.02. For interpretation, an account receivable turnover ratio of 2.02 indicates that the company ILB Group Berhad collects its receivable about twice a year. This shows a slow collection period, suggesting that the ILB Group Berhad may need to improve its credit and collection account receivable.
Now, I will briefly compare the financial performance of Ideal Capital Berhad and ILB Group Berhad. Firstly, in terms of liquidity, ILB Group Berhad clearly performs better. It has both a higher current ratios and quick ratios, showing it can easily meet its short-term obligation. Ideal Capital Berhad, although stable in current ratios, has a weak quick ratios and may rely heavily on inventory to cover immediate debts. Secondly, looking at activity ratios, ILB again shows better efficiency. It uses its assets more effectively and collect receivable slightly faster than Ideal Capital Berhad, even though both companies still have room to improve their operational efficiency. Thirdly, when it comes to profitability, Ideal Capital Berhad is the stronger performer. It records positive profit margins and a healthy return on equity, while ILB Group Berhad suffer loss and produce negative return for shareholders. Lastly, for leverage, ILB Group Berhad maintains a more stable financial structure with low debt level. Ideal Capital Berhad relies more heavily on borrowing, which increases its financial risk. In summary, ILB excel in liquidity, efficiency, and low financial risk, whereas Ideal Capital Berhad leads in profitability. Each company has different strengths depending on whether investors prioritize stability or profit generation.